We're always hearing about the stock market, aren't we? The next big tech thing, or maybe crypto swings.
Right, that's usually the focus. High growth, high risk sometimes.
Exactly. But what if I told you about an asset? Something usually seen as, well, let's be honest, pretty uneventful.
Uneventful. Okay. Intrigued. What asset?
That's actually delivered some really remarkable returns, historically speaking.
Okay, you've definitely got my attention now. A boring asset outperforming. Let's dig in. What are we talking about?
We're talking gold. Specifically, we're doing a deep dive into the performance of gold, mainly looking through the SPDR Gold Shares ETF, ticker GLD.
Ah, GLD, right. And you found something interesting about it.
Yeah, our jumping off point is this piece from The Motley Fool. The title kind of says it all. Meet the historically boring asset that has risen 610% since 2000 and crushed the S&P 500 index.
610% since 2000. Wow. Okay, that is surprising. And crushing the S&P 500 over that time frame.
I know, right? So our mission here isn't about finding the next hot stock tip. It's more about understanding why. Why has this supposedly safe, maybe even uneventful asset done so well?
Yeah, what are the underlying factors driving this? It definitely offers a different viewpoint, doesn't it? Moving beyond just the usual focus on stocks.
Totally. Now, thinking about typical investing, the standard advice often leans heavily on stocks, wouldn't you say?
Oh, absolutely. The classic 60-40 portfolio comes to mind, 60% stocks, 40% bonds.
Right. Stocks for growth, bonds for a bit of safety. And you see younger investors sometimes going even heavier on stocks, chasing those, potentially bigger long-term returns.
And historically, that's made sense. I mean, over really long periods, stocks have generally provided better growth than, say, bonds or commodities, though obviously with more bumps along the way, more risk.
But this is where that Motley Fool article just throws a curveball. Yeah. Since the year 2000, GLD up 610%.
610, it bears repeating.
And it explicitly says it crushed the S&P 500 during that time.
That really does challenge the whole gold is just for stability idea. It suggests there's a significant growth story there, too, at least over this specific period.
And what about recently? Is this just an old story?
Good question. What are the more recent numbers like?
Well, the article mentions as of late April 2025, mind you, gold's up about 26% just this year.
26%. In less than 4 months.
And over the last 12 months, around 43%.
43, also very strong.
And then looking back 5 years, it's roughly 88%. So no, it doesn't seem like just a historical thing from the early 2000s. It feels ongoing.
Right. So the big question then is why? What's fueling this? The article points a finger somewhere specific, I believe.
It does. It really zooms in on the U.S. fiscal situation as a key driver.
Okay, the national debt situation. Let's unpack that. How does the article connect the dots?
It talks about this cascading amount of debt the U.S. has taken on, really since the turn of the century. Think about the big events.
Like 9/11, the response to that?
Yeah, and then the Great Recession in 08-09.
Huge stimulus there.
And, of course, more recently, the COVID-19 pandemic. All these massive events led to significant government spending.
Which naturally increases the debt level. Do they give specific figures?
They mentioned the fiscal 2024 deficit being around $1.8 trillion. So spending way more than revenue coming in.
$1.8 trillion in 1 year.
Okay, the total debt, now over $36 trillion.
$36 trillion. It's hard to even conceptualize.
And maybe more worrying is the growing chunk of the budget that just goes to paying interest on that debt. Less money for, everything else.
So with debt piling up like that, how are the people who actually lend the money reacting, the bondholders?
Well, the article suggests there's definitely growing concern, apprehension maybe, about the long-term picture for U.S. finances.
Does it mention the credit rating agencies? Because they've weighed in, haven't they?
It does. It reminds us that S&P Global actually downgraded the long-term U.S. credit rating way back in 2011.
Right, I remember that, citing fiscal worries even then.
And then Fitch did the same thing much more recently, in 2023, again pointing to fiscal concerns.
Now, it's important to add, and the article probably notes this too, U.S. bonds are still seen as very safe, right? The dollar is still the world's reserve currency. Auctions usually go fine.
Absolutely. It's not like panic stations. But these downgrades, they do signal, increased caution, a yellow flag about the fiscal path.
And this caution isn't just theoretical. It seems to be showing up in the behavior of some really big players, like central banks globally.
Exactly. That's another major point in the article, how central banks are changing their tune, so to speak.
Changing how? What are they doing differently?
Well, it seems they're buying fewer U.S. Treasury bonds, on balance. Yeah. And instead, they're buying more gold. A lot more gold.
Okay, substituting treasuries for gold in their reserves, that's significant. Any numbers on that?
Yeah, the World Gold Council data cited says central banks bought over $1 trillion worth of gold just in 2024.
$1 trillion of gold in 1 year. Just central banks.
Just central banks, collectively. It's a huge shift. You have to wonder, are they hedging, diversifying, worried about something down the line?
And it's not just a flash in the pan either, is it?
No, the article stresses this was the third year in a row that their demand topped $1 trillion.
Third year in a row.
And get this, it's the 15th straight year that central banks, as a group, have been net buyers of gold.
15 years. Okay, so that points to a very deliberate, very sustained strategic shift away from potentially just relying on the dollar or treasuries.
And there's more data supporting this diversification idea. The article brings up a 2024 report from State Street.
What did the State Street report show?
It looked at foreign official institutions, so largely central banks again, and their holdings of U.S. treasuries. It showed a drop.
A drop. How much?
From about $4.2 trillion in early 2020 down to $3.8 trillion by early 2024.
So a $400 billion decrease in treasury holdings over 4 years from these official bodies.
Right. And the report apparently links this partly to, well, diversification into other reserves, like gold.
Interesting. And you also have the Fed factor, right? Quantitative tightening.
Yeah, the Fed's selling off bonds it owns, which also tends to push yields up.
So with central banks buying less and the Fed selling, who's holding all the treasuries now, especially those held overseas?
The article points out that it's increasingly the private sector in foreign markets.
And the implication there is?
Well, private investors might be, let's say, more sensitive to risk. If they get nervous about financial stability, they might demand higher yields, a better return to hold on to that debt.
Which could push borrowing costs up further for the U.S. government. Okay, I see the connection.
The article then tries to link rising longer-term Treasury yields to some specific policy talk, mentioning President Trump and tariffs.
How do tariffs fit into this?
The thinking, as presented, is that tariffs could potentially hurt economic growth.
Okay.
And this uncertainty contributes to that gap we sometimes see, where longer-term Treasury yields rise faster than short-term ones. That kind of divergence can signal unease about the future economy.
Right. An inverted or flattening yield curve often gets talked about as a potential recession indicator, though it's complex.
Exactly. But it's not just about economic stress or debt fears, is it? Gold has another traditional role.
Ah, yes. The inflation hedge.
Right. The article touches on that too. Gold as protection against rising prices.
Because it's a physical asset, finite supply, unlike currencies, which can be printed.
And it even quotes billionaire investor Paul Tudor Jones. His view, apparently, is that the U.S. might eventually kind of inflate its way out of the massive debt.
A controversial idea, but one that's out there.
Yeah.
Basically devaluing the debt by letting inflation run hot.
Leading him to say something like, all roads lead to inflation. And if you believe that,
then holding an asset like gold, which tends to preserve purchasing power during inflation, looks pretty attractive.
So wrapping up this section of the analysis, the article sort of gently suggests that maybe having some gold exposure makes sense in a diversified portfolio.
Right. Maybe through something easy like that GLD ETF we mentioned.
But, and this is big, but they are very clear. This is not advice to dump all your stocks and pile into gold.
No, definitely not. They balance it, right? They probably mention the long-term track record of stocks.
Yeah, they specifically reference the Dow's strong performance between 1990 and 2020 as an example. The underlying belief in equities for long-term growth is still there.
So it's more about adding a potential diversifier or maybe a hedge, given these specific economic currents we've been discussing?
Precisely. It's acknowledging that, okay, stocks are usually seen as the main engine for growth, yeah. But this deep dive shows gold has had this really surprising run.
Driven by these big themes, U.S. debt, central bank shifts, it's definitely pushed gold beyond just being seen as that boring safety play.
It really has. So maybe here's the final thought to chew on for you listening.
Okay.
Given these trends we've talked about, the debt, the central bank buying, the inflation concerns, how might adding a bit of something traditionally safe, like gold, actually fit into your investment plan?
Does it make you maybe question the standard 60-40 or the all-in on stocks approach?
Yeah, maybe it challenges that a little bit. It's definitely food for thought, isn't it? Worth considering how different kinds of assets might play a role in your own long-term financial picture.